Welcome to Financial Detox. We're your hosts, Jason and Alex from IDA Wealth. Your financial journey of pursuing better and true financial peace of mind starts here. Hello, welcome to Financial Detox. I'm Jason Labrum, your host in studio with Alex Klingensmith.
Hi, everyone. This is Alex. We were just arguing before the show, which is great. It makes for a better show, debating. We're going to talk about bonds, which I don't like. So this is going to be fun for Jason to make bonds interesting to everybody.
Yeah, come on, Alex. I mean, I know you're laughing and making fun of bonds in general, but what are we going to talk about?
Does high yield mean high income? If you have a bond and it's paying a high yield, are you guaranteed that income? It's great, right? We're guaranteed. I get the yield. I get the percentage. I'm good to go. My investment's solid. Buy bonds.
But I think where your question and where the phrasing of the setup of the show could even be pivoted more is it's not just bonds. A lot of people are buying high yield stock or BDCs or REITs. There's lots of investments that present high yield. And that can be a really attractive attribute of something like, I'm going to buy high yield stocks. So it has nothing to do with bonds. There you go. Now you're happy, right? Because we're talking about high yield stocks, not
dividend stocks. Well, I don't like those either. For the same different reasons, I don't like those, but I hear your point. Yeah. Total return is the approach you'll get to, I'm sure, but not just chasing after yield or dividends or whatever else. The high thing, it could be a bait and switch. It could be not what it's too good to be true, right?
That's it. I think Alex, we have defined, folks, is clearly an equity zealot. That means
I like double backflips on the roller coasters in Magic Mountain. Legoland was fun when my kids were 5, but I'm good now.
No, what about like the Hulk Hogan at in Florida? What's that, Orlando, Disney World, whatever? The Hulk Hogan and the Velociraptor, the two coolest roller coasters ever. Have you ever been on those?
I've never been to Disney World or Orlando, but I have gone ziplining in multiple countries. So I can relate to that in the sense that like I like things that have that sort of danger as long as they are not going to kill me, which I think stocks aren't going to kill me, especially if I'm diversified.
Financially, they'll kill you.
If I'm concentrated in one only or maybe one sector or timing and all these things. But if I'm diversified and have a long-term approach to rebalancing, what's the point of having an asset class that's going to definitely underperform?
Yeah, and we'll get to that bonds versus stocks and why own bonds in your portfolio, because it is a really good question. However, it's not the question for today's show, because what's come up and what we're hearing a lot from clients is volatility's coming back. There's a military operation, aka war in Iran. What are we going to do with our portfolio? Shouldn't we just buy some high yield stuff? I personally have made this mistake myself in my career in the past, or as an investor in the past, and I'll share it because I think one of the most phenomenal things we can bring to clients is all the mistakes that we've made personally. And more importantly, or as importantly, we've seen people make mistakes too. Sometimes we're not able to psychologically and behaviorally coach somebody into the right decision making. So we see them make a mistake and we're like, it sucks. But they make the mistake and we get to see that present itself. One of the things I've done is I've chased a high yielding investment. In my situation, it was a closed-end fund. So it's operated like a mutual fund or an ETF, kind of a hybrid of those two. And it had a very attractive 10% yield. What I didn't do at that time, this was early on in my younger investing days, was I didn't really unpack what was creating that yield. Where is it coming from? Well, it turns out in my scenario that it was about a 9 or 10% yield, which at that time was really, really attractive, like now. And most of that yield, there was only a couple percent actually coming from true returns of the underlying portfolio. It was all return of your own capital. It was like a legal Ponzi scheme where you invested and they promised you a certain yield. In this case, they didn't promise you a rate of return if you read the prospectus. They promised you a yield, and that yield was just getting your own money back. So
sounds like an annuity.
It was bad. Yeah, kind of like an annuity in that regard. But not only did you got your own money back and you thought you were doing great because you got the yield, but yet the price of that just kept going down because they were returning capital. They were returning your own money. So the price went down. I had a great yield, but yet if my average annual return was a negative 8% and I had a 9% yield, then I returned 1% a year, which wasn't good. That is and can be the real issue when we go chase yield. One of the things that I think really comes into play here is deciding what is the total return of the investment? What part of that is coming from cash flow? And is that cash flow sustainable? Alex, I think we've even seen this present itself in real estate, where investing in real estate can be really tricky, right? Because you can go look at something and there's leverage, right? You buy a $10 million property, but it's leveraged by $8 million or $9 million of its leverage. And so you're getting a return, but the return may not even be enough to actually cover the cost of all the operating costs and the expenses and the cost of the leverage. So even though you think you're getting a nice yield, it's a negative real return or negative total return.
Yeah. It's unfortunate too, because I think, well, this goes back to why we even do this show and why you even wrote the book, however many years ago it was, not 10 years ago?
Too long. 8 years ago.
8 years ago, is because there's so much information out there available to people. And most of it is, well, it's almost all self-serving, because if somebody's building a product, they want to sell the product. If somebody's selling you a real estate investment, they're going to show you the part that's the most interesting to you, the most attractive to you. And maybe without lying or omitting information, they just won't maybe make that font size as big as the other font size, right? It'll just be in like page 912 of the PPM or whatever. That's the problem with some of this stuff, is it can get very complicated very fast. Bonds shouldn't be so complicated. Like back to like the initial, I was attacking bonds. It's a boring roller coaster ride for me. Why do it if it's boring? I want the risk. I want the volatility, because in exchange for that, I want the higher reward, expected reward long term. But if you do have something that's yielding something, let's go back to bonds for just a minute. It should be relatively simple, right? I'm going to lend you money. In exchange, you're going to pay me an interest rate, the yield in this case. Then you're going to give me back my money, hopefully. None of that's guaranteed, but it's likely that you're going to give me back my money. But then the higher the yield, the higher the risk, right?
I think you have to associate higher yield with something's going on here, right? Somebody told me the other day, I buy this, and they ended up talking about, I unpacked it. It was a BDC. So it's a business development corporation. It's very high. Favorite. It was very high risk. Some of those are good, but some of them are very junky and crappy. And they said it's a guaranteed. No, it's guaranteed. And I'm like, what do you mean guaranteed? Like a guaranteed 11% yield, something's wrong, right? Because if the risk-free rate of return we can generally all agree upon would be like a 1-year treasury. The United States government fully backs and guarantees its yield, and that if you buy a 1-year treasury bond, they will give you your principal back after paying you interest for 1 year. That's a risk-free rate. And if that risk-free rate is in the high threes and you're getting an 11% yield, why? It's not because it's risk-free.
The small print.
It's all in the small print. So, and you need to understand that. And I think that's what we're getting at. And I think the headline here is there is a gigantic myth that because it's high yield, it's a great return. It's good. High yield is good. I'm going to go chase high yield or high return or high dividend. That does not necessarily mean it's good at all. And I think you really have to unpack what's generating those returns. Is it a return of capital, or is it based upon leverage that if the cost of borrowing goes up, that whole thing's going to blow up? We've seen that happen in real estate, right? If you owned multifamily or commercial industrial real estate office and you just had them leveraged at 60 to 75%, and the pro forma was based upon borrowing costs from 6 years ago, and they didn't factor in a 5x increase in borrowing costs, then all of a sudden the whole pro forma and the whole yield scenario just gets blown up. So it's a risky proposition to chase yield. Very, very risky and extremely complex. Like, it's not for the faint of heart to go understand and unpack where an investment is saying the yield is coming from. Yield being totally different than total return, because total return comes from maybe some interest, but also maybe from capital appreciation, different things that can contribute to total return versus just yield.
Do we want to talk about U.S. private credit versus U.S. high yield? I think there's a chart on that. We could maybe, if it helps this story that you're talking about right now.
Yeah, I think the chart, as I was reviewing it pre-show, you're looking at just basically the market size of what's going on in the high yield market size, and it's an interesting space right now. If you take this to like fixed income lending, because you've probably heard of private credit. In some way, shape, or form. You probably don't own it because most investors don't own private credit. But, due to a lot of the credit crisis and what happened, banks have all but left the middle market lending business. So that whole banking, lending, credit business has really become now a private markets business where there are private credit funds and there are all kinds of shapes and sizes. So we talk a lot about alternative and private investments on this show, right, Alex? And we're proponents of it. And we think it's important to have that in your portfolio if you can intelligently do it and do it in a nice diversified fashion. But the problem in private markets is they can be very complex. They can have high expenses. There can be a lot of things going on. So you really want to be smart about how you unpack it and understand what you're buying. And I think that one particular slide is looking at US private credit versus high yield, how much money's on the sidelines and what is the unrealized value. Kind of an interesting slide. I think we could probably spend a couple of days on it. So I might not want to get into it. The slide that
just different kinds of yield is the theme though here. We're just trying to help people see. Another one that is this bubble chart that was up a minute ago that I'm just going to be honest. I don't understand all these numbers and things. Is this helpful to walk everyone through this? Because maybe what's trying to show us is kind of where risks do exist in this topic.
Yeah.
Where there may be there's less risk versus which one is the double backflip loop roller coaster versus the one that's like Legoland.
Yeah, I think what you're looking at on this chart is you're looking at 10-year annualized returns on the left side. So the higher something goes on the chart, the higher the 10-year annualized return is. And then you're looking at correlation to a 60-40 portfolio, 60% stocks, 40% bonds. Like how much has that acted like and behaved like a 60-40 portfolio? You see the big bubbles, transport, infrastructure, private credit, 60-40 portfolio over there. I'm not sure what this is really going to tell us, what we can derive from this, except that you've got a little bit of a warning shot over the bow, I think, on private credit. And you've seen this happen. Some names recently, Blue Owls hit the news with just different things that are starting to present themselves in the markets. And I think you have to be really careful as how you go chase yield. If you're looking for yield, nothing wrong with that, right? If I'm an income investor, I'm an investor with my goal is to generate income from my portfolio. That might be a reason you want to own some fixed income, Alex, even though you don't love fixed income and bonds.
No, I'm not sold at all. I'm going to go back to the total return is a better solution. It's probably more tax efficient as long as you're paying attention to the tax part.
Total return is, but part of a total return strategy would be that you have some interest from bonds, you have dividends from stocks, you
ordinary
have capital
income
gains.
interest. Ordinary income interest, though?
But not if it's in your IRA. It's not ordinary income because it's already going to be ordinary income. So it's no tax disadvantage.
I don't know, man. I think that the long-term appreciation of some of the asset classes that have no yield at all are more interesting to me.
Possibly, but if you need income to live off every single day and you're a skittish, nervous investor who doesn't like volatility, it can make a lot of sense to create
Legoland.
Legoland roller coaster versus the Magic Mountain, but also it's about generating reliable, consistent income too. So what I'm saying is that to look for yield is not a bad thing, but to go chase high yield, that can be a real problem in your portfolio. You can build yourselves all kinds of impending potential risks that could end up being a real shock to the system, and you may not at some time want to absorb that.
What if you got on a Legoland roller coaster because you thought you were chasing the right kind of yield and it turned out that you ended up being on the wrong ride, like the really scary one, because they sold it to you as if it was going to be the right income instrument. In fact, it turned out to be something that
you ended up upside down doing a triple loop.
Yes.
And I think that happens a lot with chasing yield. And that was the key. That is the key to this whole segment that we're doing in this show that we're doing is like, does high yield mean high income? Does high yield mean good returns? Or does it mean that there's some uncertainty? And I think what high yield, something that chasing a high yield or chasing a high return generally means is there's some uncertain things behind that, and you should know what they are. It may be the double loop on the roller coaster up ahead. It may be that there's really impending risk. It may be that you're getting your money back, and that's the only reason you have a high yield. You're not actually returning anything. I think one of the classic examples, and there are some cases where annuities make sense for people, but a lot of these annuities these days are sold to people on guaranteed lifetime income. But the guaranteed lifetime income is just getting your own money back. Unless you run totally out of money, then finally, the insurance company will actually pay you something. But yet they build it and present it like as if it's actually an income. Where had you just bought a 5% yielding corporate bond, you would have actually got 5% real return and still kept all your principal aside. So there's a lot of nuances to this, and chasing high yield is not a good thing. Beware, pay attention to this, and check us out at financialdetox.com or at IDA Wealth, our investment firm, if you want to get help understanding if you've chased yield and you might be holding on to a lot more risk than you think. And these are the times when you start to have real market volatility presenting itself in the markets. This is the times when that chasing high yield will come undone and bite you. So you want to be careful, and you want to make sure that the yield you're chasing or the yield you have is understandable and digestible. That's it. It's Financial Detox. We got to spend some time on these tough topics to help you be financially detoxified, avoid behavioral blunders, and manage your wealth for maximum impact. That's it for today. I'm Jason Labrum. Thanks, Alex, for always moderating and hosting our show. We'll catch you on the next show. Tune in, Financial Detox. Check you later. Bye-bye.